Hey guys, today we are going to talk about cryptocurrency price variability and how people are making money from it. But first, click over and watch this on YouTube. This blog is published on multiple social platforms, so it's hard for me to keep track of everything. At some point in the near future, I am going to move completely to YouTube, so please subscribe so you don't miss out. And with that in mind, let's get started. Blockchains promise a much quicker and lower cost world for regular people. My personal view is to really see the benefits of blockchain at an economic level, we need a few things in place. And one of those things is a currency as an effective store of value, which we don't have at the moment. And this is where it becomes really quite difficult. We all know the variability of the various mainstream coins, which isn't helping regular people use blockchain technology. So we need to stabilize that value so that tomorrow the currency that you've bought is worth what it is today, some predictability. But why is that important? Why do we need to do that? Well, if we don't, there are consequences. We can look at history so that we're not doomed to repeat it, to understand these consequences. Now, before World War II, 44 allied nations wanted to improve their ability to do trade internationally. They couldn't achieve it previously because the values of currencies varied wildly between different nations. So during World War II, the Bretton Woods system was agreed by 44 allied nations, which pegged their currency to gold. This stopped competitive devaluation and ensured no more than a 1% drift in value occurred between any country. That was very successful at the time until the US decided to break that agreement with the so-called Nixon shock in 1971, which consequently improved America's competitive ability because they weren't limited like the other countries were. But that didn't last long. Most countries quickly followed to become free-floating in their currency. Reminds me really of Brexit and what's happening here. Today's money, fiat money, however, is still a store of value that is not linked to a physical asset, such as gold or silver. The claim on money and the reality of having money are two very different things today. And in fact, if you look on any British banknote, it clearly says, I promise to pay the bearer of this note, etc. So even the printers of the money don't believe the note is actually where the value is stored. The value must be stored somewhere else then. The promise by the issuing entity is the value, someone's promise. In other words, what is money other than a belief that money holds value? Sounds like a very similar problem to what we have in crypto right now, doesn't it? Well, we have a solution for regular money. So can we bake in stability to our blockchain cryptocurrency in a similar way? And the answer to that is yes, we can, or at least we can try. And there have been various experiments to achieve this, the so-called stablecoins. The main premise behind stablecoins is that they are backed by something. They don't just exist like Bitcoin does. The first approach is an attempt to offset currency fluctuations by guaranteeing value by pegging a coin one-to-one to a regular fiat currency. The idea of a digital dollar has been floated around for quite a while, and even in 2016 Obama mentioned it, and even Canada had something similar at the same time, if I remember rightly. It's a straightforward idea. You keep $1 in a bank account for one each digital dollar. You redeem them at will. Another way to stabilize currency is to back it by collateral, an asset. You buy an asset that is stable and offer redemption options on that asset to stabilize the prices of the new coin. This was originally done with gold, the Bretton Woods system we talked about earlier. You can also back it by owning derivatives, which will enable that asset to rise in value along with inflation. A good idea because your money is earning more money. This technique is applied to many large asset bases, like insurers do it, pension funds do it, and so on. And in the crypto world, we have something similar. This is sometimes being done by the stablecoin issuer buying an index of other cryptocurrencies and balancing their asset base. They then limit and issue their stablecoin to match market demand and stabilize prices. Another way, you can back your coin with new inflows of money, such as what the Basis protocol, also known as the Basecoin rebrand, is trying to do. This is to keep attracting investors in their currency, the Basis protocol currency called Base, through the sales of what seems to be quite complicated derivatives, their Base shares and their Base bonds. When the price of Base goes up above $1, the shareholders issue new coins to bring the price down. When the price of Base goes down below $1, Base bonds are printed at the lower value, which can be redeemed at a later date, hopefully at the stable price of $1. Now, both of these mechanisms are used to then manipulate the price of Base and to keep it at that $1 mark. But pegging has some fundamental problems, which I think most people aren't really considering. The messy organic world of humans who, when gathered in large herds, tend to screw up most things through bad maths, opportunistic greed and concerted manipulation. And the Basis protocol suffers from one or more of these. You see, it relies on investors thinking that the value of Base will rise. And if it doesn't, bonds, or really their options to give them their accurate name, can be printed as much as the Basis people would like, but they will never reach the $1 in sale price. Basis will have still made their money though, because they're the ones printing the bonds and selling them for real dollars. This means that it's in the best interests of investors to evangelize on the Basis protocol and bring on other investors to buy bonds and buy currency, whether they think it's a good idea or not, to protect their initial investment. That constant attraction of investors by investors has another name, sometimes a pyramid scheme. Being careful of who backs coins is actually critical as well in understanding coin stability. And Goldman has just announced a USD-pegged cryptocurrency on May the 15th, 2018, with their new acquisition, Circle. They are building coins that are pegged exactly to regular dollars. They call it the USDC, USD coin. Seems great on the surface, and Goldman's, but the main reason I'm concerned with this is that the Circle company has announced an investment of $110 million from Bitmain. Now, Bitmain is a company embroiled in controversy, from filing an ASIC boost patent which exploited a flaw in proof of work, to their Antpool subsidiary, which was recently outed for potentially manipulating Bitcoin cash price by burning some of their mining gains. Both of those that really don't inspire confidence in USDC for me. And this is where transparency is important, because transparency is a key feature of any form of stability. We didn't mention Tether, but it's worth mentioning now, which is another stablecoin backed by USD, which has issues. Although it's backed by USD, they don't allow you to redeem USD from them. They require you to have faith in however they are managing their USD assets, because they don't tell anyone how they do this. These complaints were noted and they responded, and they issued a proof of funds in a bank account, but they redacted it. And so we don't know how much money they've really got. We don't even know which bank it is, and we don't know which part of the world that money is in. We don't even know what currency it's in. Then there's governments. When you peg, you directly or indirectly connect yourself to an economy of what you're pegging to. With cryptocurrencies, this seems to be the dollar. And in the US, this makes sense. But does it make sense for every other country? You know, the other 7.1 billion people in the world. Now, I'm a big fan of Kazakhstan, thanks to some family connections there, and there are some lessons to be had from their short 25, 30-year economic history post-Soviet Union. Kazakhstan was bitten by pegging a few years ago, where their country's currency, the tenge, suffered from 2 government-led devaluations. The real bite was that large items like cars and houses, you actually buy in dollars there, meaning that the connection to the dollar forced at least a 40% rise in prices of houses and vehicles, which is great for investors that own properties and vehicles, but not so great for the regular person. Again, it benefits investors. And this can easily happen to cryptocurrency when their paymasters change minds on how to manage the supply. Remember, cryptocurrency has no regulatory oversight at the moment. This includes both flaky currencies, such as Tether and the Basis protocol, but it also affects really well-known currencies like Ripple's XRP, for example, who seem to be creating their own central bank these days. It's worrying stuff. Now, in summary then, because we should wrap this up, there are a number of ways to peg. You link to an existing currency, you link to collateralization or collateral, and then there's the derivative level index fund. And which is best? And I don't know. Humans are very messy creatures, and today's stablecoins don't seem really to take that into account. Stability in regular markets is maintained by international agreements, regulation, and other levels and levers that Keynes and Friedman will have decades of debate over. It also sits very uncomfortably with me that currently these extremely networked and chaos exhibiting economies we're building through coins are proposed by computer scientists and investors. The former aren't trained in macroeconomic issues usually, and the second are highly biased towards personal profit by definition. So maybe, just maybe, we need economists, politicians, and God help us, lawyers, to give us ideas about how best to deal with these currencies and make some solid propositions on the same world-changing scale as we saw with Bretton Woods and the Nixon shock and the European exchange rate mechanism. Now, these have obviously had their own problems, but they represent the types of changes that cryptocurrencies will need to go through, and possibly regularly, to maintain that indefinite stability we're looking for you and me. Anyway, let's carry on the conversation below, and please hit that button, subscribe, and the like one, maybe even the little bell thing that will tell you when I've posted. It's appreciated, and I'll see you next time. Take care.